All right. Well, without further ado, I think we can go ahead and get started this evening. So thank you everyone for joining us. And I will actually turn on my video because, thank you for the feedback from our last webinar that people wanted to see who is actually managing their option strategies. So here I am, the man behind the curtain. But no, thank you seriously for everyone joining us. Before I get into the webinar and introduce our very special guest with us this evening, I just want to put out a couple disclosures that this evening session does not constitute financial advice, that this is purely for the purposes of education, and nothing that my guest or I say in any way represents a suggestion, recommendation to buy or sell securities. So now that that's out of the way, I can take a minute to introduce our guest this evening. Maddie, who is our Director of Education here at Harvested Financial. So Ian's got a long career in the derivatives industry, trading both equity as well as crude options, oil options. And he's also got some background in the education space too. So when he reached out about Harvested, we realized this was a perfect combination. So welcome Ian, and thanks for joining us tonight.
Hi, Mark. Hi, everybody. Thank you for joining our webinar tonight. I'm excited to discuss options, spreads, naked puts, and help everybody kind of understand a little bit more about trading and how it fits into your portfolio. So I'm excited to be here.
So I think we can just go ahead and get right into it then. So the theme of our discussion tonight is how do options strategies make money? And we're actually going to focus particularly on one specific strategy, and we're going to step through a series of different events that combine to become a strategy. But before we get all the way into all the fun examples, I think we want to talk about first, what is a strategy and what does a strategy mean to us at Harvested, and in what context do we use that word? So for us, strategies are very much the core of our service. We provide strategy execution as a service. And a strategy means to us a defined set of parameters. And it's a defined set of parameters in terms of a prescription for how that trade or a series of trades will be done over time. And one of the ways we want to think about those parameters is that they're adaptive to different market environments. So for example, one of the parameters we might use to define a strategy would be the delta of an option. And so by defining the strategy in terms of the delta, we can stay reactive to different volatility environments. Whether it's higher or lower volatility, we might want to sell a different option that's a different moneyness away. So we'll see that a little bit later, but it's important to think about the parameters that define these strategies and the prescription for how we're going to trade going forward. And that trading going forward is that systematic execution. So strategy isn't just about one trade. And, I think we'll step through sort of how one trade composes a strategy overall, but really the benefits of options strategies and the benefits of options strategy execution as a service is the systematic, ongoing, repeating trades and the repeating capture of certain opportunities in the marketplace. So it's not just about, the one trade that you execute with certain parameters, it's about how that behaves over time. So that's what we mean when we say strategies here at Harvested Financial. And I'm going to go ahead and turn it over to Ian to talk about sort of how we compose those strategies and thinking about the risk management element of strategies, because risk management is a core part of trading options, and it's something that we really want to have a handle on when we're executing those strategies for clients.
Great. Thank you very much, Mark. Okay, so we're going to talk about spreads versus naked options. And like Mark said, a good portion of being successful in options trading, whether it's just specifically options only or options with an underlying, is the risk management aspect. Being systematic about the approach to placing the opening position, but almost more importantly is after your opening position, risk management. So understanding all of that, will really help, improve your portfolio gains over time and help you at times when you want options to minimize losses. That's what they're there for. Today, we're going to talk about a downside capture example. So I'm going to share my screen in 1 second, and we're going to look at selling naked options We're going to look at spreads. We're going to compare the two. Then we'll look at some practical applications and expiration. And a lot of terminology we'll go through. And then, we'll find out a couple questions you have, and maybe we'll talk about the Greeks. All right. So I will just go and share my screen in 1 second. So let's see over here. Sorry, just take 1 second. We'll get up my screen over here. Mark, you might need to hit that button for me. There we go. Perfect. All right. So everybody should be able to see now. We have a graph of selling a naked put. We'll go over the naked put in 2 seconds. First, what you're looking at is a TradeHawk screen. TradeHawk is a front-end application used for pricing options, all types of equity options, ETF options. It also has a lot of unique functionality to derivatives, which is looking at the risk inherent in those trades and those positions. One of my favorite things coming from my risk management, trading, and education background is the what if scenarios. Really important before you put the trade on, understanding the risks. So these what if scenarios that we're going to analyze through TradeHawk make it really possible to look at the trades in many different ways. But at the same time, simplify it, right? Because you don't want to necessarily have 1,000 more data points and just be like, okay, well, there's just too much data to make a decision. So let's look at our naked put. So the first thing
Ian, walk us through what a naked put. What do you mean by naked? What does that mean?
Excellent question. A little strange terminology. We're going to go look at our naked put. So 1 second. We are going to go look over here. Okay. So on my left now, we have a different set of screens. Option traders love numbers, right? But again, we want to simplify things. You shouldn't have to look at millions of numbers to be able to come up with this strategy. Say, hey, you know what? I am somewhat bullish now. Think after the election, through the election, after the election, maybe the market's not going to go up a lot, but I'm bullish. I have a long thesis, but I know that implied volatilities are high. We could talk about kind of that concept after. So how do I take advantage of that? I don't want to buy a call because implied volatilities are high, which just means that the price of the options are higher. As your implied volatility goes higher, it's kind of like pumping air into a balloon. Balloon inflates, well, guess what? The prices inflate. So you say, you know what? I am slightly bullish through the election. So what I'm going to do with implied volatilities high, I'm going to sell an option. And by selling that option without any hedge or underlying instrument against it that would, in essence, hedge it, you are naked selling that option. So the option terminology is very old. You say you're naked short an option. In this case, we're going to be naked short a put. And let me see here. I'm going to get our annotator up. Okay. So we are going to naked short the 324 put. SPY is trading lower after the bell, but let's say, at 3 p.m. Eastern time, SPY is trading $338.22. And we have this long thesis. You're slightly bullish throughout the election. And these are the November, make sure we're on the right ones, November 20th expiring options. We'll talk about expiration a little more in a few minutes. 24 days to expiration. Implied volatility is definitely on the high side, 33. Say, okay, you know what? I am going to sell this put, and that's it. So I'm going to sell one put at roughly $6. So now we're going to go back to our what if scenario. So this is your only position. So now I'm going to
when you sell that put at $6, what does that mean? Do you get money now? Do you pay money? What happens?
So what happens is practically you are now short one option in your account, and you are going to receive a premium. You're actually going to receive money in your account. And let's say you sold this option at $6.04. Because the multiplier of stocks in the United States is 100, you will receive $604 into your account. Great start, right? So you're receiving premium. It's almost like selling insurance, right? You're receiving the premium up front. All right, so now you say, okay, Ian, this graph looks really good, right? Right. I sold this option and I see 604, 604, 604, 604. Looks all good, right? What can go wrong? So let's talk about it. So traditionally, when you look on different option websites or just brokerage websites, you'll see what is called the expiration graph. So this green line over here is our expiration graph. Now, that means 24 days from now, forget what happens in between. Let's just look 24 days ahead. If the stock closes at 336, let's get our annotator back up over here. If the stock closes at 336, I make $604. If the stock closes 332, I make $604. I make $604 all the way to $324, which is $14 less than the current stock price, which is roughly 4%, let's call it. All right, all good, right? Well, then we kind of notice a little bit of a blip down. So what happens there? So now what we're going to do is we're going to recenter our price, and we're going to recenter at 324. And I'm going to hit calculate. Okay, so now things look a little bit different, right? Still above 324, we're golden. You make your entire premium that you sold. You sold the option at $6 and, 2 cents. And then, so you're up $602. Perfect. But once the stock starts going below the strike and there starts to be intrinsic value there, which just means it starts to perform more and more like stock and not just a simple out of the money option. And again, you could always ask questions after. I know we have a lot of terminology here. So originally you sell an out of the money put. It's $14 out of the money, meaning $14 away from where the stock is currently trading. Okay, great. Stock's at 325 on Friday, November 20th at 9:30 a.m. Eastern, looking good. Well, what happens if the stock starts to tick down at 10 a.m., 11 a.m., noon, 1 p.m.? At 2 p.m., the stock is trading 318. That's your break even. So now there's 2 hours to go and you are still naked short this option. So you have no protection. So that's kind of where the naked terminology comes from. What happens in this situation? So if the stock keeps going down, all of a sudden your nice premium, that $600 disappears, and you can kind of see the straight linear line down at a 45-degree angle means you're going to lose $100 for every dollar stock goes down. So if the stock really, really went down, and let's say, it's possible, right? It's the stock market. We'll recenter at 300. You can see that, and this is just one contract, remember, just one contract, that all the way down to 284, you would lose $1,600. So naked short, great for, you have this bullish thesis, slightly bullish thesis, high volatilities, you're selling out of the money put, starts out great because you collect money, but the risk is you can lose, not necessarily unlimited, but you clearly, because stock can only go to zero, but clearly before it gets to zero, that's a lot of money to lose. And depending on what kind of accounts you have, that could really add up in terms of margin and stuff like that. So, and practically what happens on expiration day, right? You could be really anxious, right? It's 2 p.m. and it's 2 hours to go and you've seen the stock moving all day. Like, what do you do, right? So practically, there's a lot of risk and anxiety potentially in this position. Okay, so I'm gonna stop for 2 seconds and, if anybody has any questions, please let me know. All right, that's our naked put strategy. So now we're going to move into a defined risk strategy, a spread strategy that you can set up like Mark stated earlier with parameterization. And the nice thing about defined risk, which we love at Harvested, is that you can define your risk and your gain. And that's really powerful when you're looking at your portfolio as a whole and trying to understand it. So what we're going to do is now we're going to create a spread. So I'm just gonna go back over here. And now we're going to buy the 314 puts. So I'm just gonna click here. All right. And then I'm going to click on my fancy what if button. Okay. And now we're going to go back. All right, great. Everybody should see the new what if. All right, so now we looked at the naked option, we looked at risks, we looked at rewards, we looked at kind of what happens on expiration and some of that anxiety. All right, we have a question. I will get to that in 1 second. Thank you, Blake. Okay. So we have our defined risk. So now all of a sudden you say, okay, Ian, I'm only making $200 over here on a one lot. Remember, this is for selling one contract. You obviously can sell more than that. So you make $1. You make roughly $200. What could you lose? So let's just kind of cheat and go ahead and go down to 324 for a second. Calculate price. So now I can see I can only lose up to $800. So while my upside is capped at 200, my downside is capped also at 800. So this stock could even go down to, 289, and, so I don't know what happened there. It would say, let's get back to our price. I don't know what happened to our graph over here. I apologize. It would say that you would just lose the $800. Oh, I think it might just be off for the scale for some reason. Did I hit the wrong price over here? Let's see over here. We'll get back to our example. I apologize. It seems to be off scale. So the most you could lose is $800. So how do you lose $800? The difference between the strikes, 324 and 314, is 10. You collected $200 by selling the option at $2. And the difference between 10 and 2 is 8. So the defined risk spread still takes advantage of the bullish thesis, slightly bullish thesis, still takes advantage of higher volatilities in the marketplace. But now you can actually go into the marketplace and understand your risks a lot more, especially as you get to expiration, which is really important because you could have a lot of different things going on in your portfolio and you don't want to necessarily have surprises blowing up on you. So the power of the defined spread is really just giving you not just less anxiety, but kind of knowledge on how your portfolio will react to certain market conditions. All right, so we're just going to go back here for 1 second. And what if, we're going to, okay, so let's, all right, so we're going to get to that question in 1 second, I promise. All right, I think we're back over here now. Okay. Okay. Oh, I see. I apologize. You know what? I apologize. I see what I did. You know what? I was looking at the wrong price. I apologize. So you sell the put spread, and then you collect $2. Oh, why is it? I apologize. So you should be, something is off over there. You should lose 700, almost $800. So let's just recenter over here. I think we're just having it. There we go. Now we're back. I apologize for the graphing technical difficulty. So you see that as the stock starts moving down to 314, you start losing that 45-degree angle again. But now we're back to only losing $800. I'd say only, but obviously in the other situation, stock keeps going down, you keep losing. So in some sense, it really isn't only. All right, so before we compare the two a little more, how do you balance maximizing expected returns from selling credit spreads while reducing risk? It's an excellent question. So some of it definitely has a lot to do with just your personal kind of preferences and like thoughts in how you react to volatility. So that is part of it, right? So, you could look at different prices, and that's what we want to do at Harvested for you. So you can look at a range of credit spreads, let's say, for different strikes or delta ranges like Mark was discussing earlier, where you can say, okay, I'm collecting $200 versus losing 800, or I'm collecting 400 versus losing 1200, but the strikes are a little further apart. Like now I have room down to, down to, let's say 304. So I have $34, which is 9.5%. I'm willing to take that risk. So the answer is kind of, we'll be providing, ways for you to look at that risk of how much you collect, where's the break even, and where does the max loss occur. So, and then part of it really does come down to, Harvested as a registered investment advisor, we have fiduciary responsibility to you. We want you to understand also like your risk tolerances based on volatility in the marketplace and what you could potentially lose versus make. All right, so
exactly, and I'll just add on there, Ian, that like one of the good things about spreads is that it allows us to really help manage a risk budget pretty well and set expectations, and like, where you want to parameterize your strategy in terms of your aggressiveness kind of is that personal decision in terms of choppiness. Like, the closer to the money options are going to have more of that rich volatility premium that seems lucrative to sell, but it's going to create a much more choppy kind of portfolio experience. So that's really kind of the benefit of having custom parameterizations in there.
Perfect. And then, something else, we've been looking at the expiration graph, but something we want to do at Harvested too, more important than the expiration graphs is you have 24 days until expiration. What happens before then, right? So your parameterization to create your position, and then your risk management and your potential loss or gains, like how does that perform in between? And it's really cool with TradeHawk down here. You can just click on the different days up until expiration. And again, you can customize a little more. Right now, it's just kind of looking at every 3 days. And you can kind of see how the P&L moves, because options move a little bit differently than they do on expiration day, with 24 days to expiration, 20, 18, right? There's a lot there to go over and review, but it's really important just to understand that defined spreads have optionality, naked options have optionality, which means options have unique risks to them. And understanding those unique risks will help you understand how a naked option, a naked put, like we looked at earlier, the 324 put, has a lot more optionality or Greek risks, as opposed to our current spread, where we are less susceptible early on, especially to movement in volatility or decay or stock movement. So let's see, I think we might have a question over here.
Yeah, I was going to grab that question. So thanks for the question, John. I think that it's so if we set a predefined risk level, can Harvested take us out of the trade at the risk level? And I think the answer to that is absolutely yes. That, in trade management, that's one of the big questions is, sort of managing this over time. And as Ian's alluding to with these different charts that, as both the underlying moves and as time passes, options develop different positions. And so whether it's based on a sort of predefined profit level is something that makes a lot of sense in a spread. People like to look at a 70 or 80% profit level as like a take profit level. And that's something interesting to capture in a spread. But then also thinking about parameterizations like Greeks in terms of managing an overall book is definitely something we think about. Because of all these added dimensions, do require sort of tailoring over time. And that's sort of also the role that we like to play as the advisor here in this whole position.
Yes, that's an excellent answer. Great question too. And, looking at these scenarios and these simulators really help, understand the defined risk. And if we looked at the naked put just by itself, day by day, day 22, day 20 days expiration, 18 days expiration, and we started to adjusting what we call the Greeks, you would see some really interesting things happen to the position. It could be on the good side, but it could also be on the bad side that are even kind of worse than what the expiration graph would show you. So that's why part of the or not just part of, but inclusive of your option trading experience has to be in between expiration, right? And it could be 24 days, it could be 240 days. So we want you to understand kind of the risks and rewards as your options move throughout time, because passage of time is definitely a very important concept in option trading.
Definitely. And actually, Ian, you said a little buzzword right there that I think we've been throwing around, but I want to put a poll out to the audience about the Greeks, because I want to make sure we're using terms that everyone's familiar with. So take a look. I just threw out a poll about Greeks, whether the audience is familiar with them and whether there are any that they would, particularly be interested in, hearing us chat a little bit more about. So thank you, everyone. Responses are streaming in. A nice mix of both familiar. Generally, the audience is familiar, though. About 2/3, 3/4 are familiar. Some shrugs out there. But overall a mix. All the Greeks are interesting. I agree. So between Delta, Vega, and Gamma, I think it's also hard to pick. But some interest in Vega, I would say, actually is the one that's nudging ahead a little bit here. So maybe I might take this question, because I think Vega's interesting because it has to do with the sensitivity of an options price relative to volatility and then how that options price is going to increase or decrease relative to an increase or decrease in implied volatility. So if the price of volatility, the price of insurance, the general temperature of the market has been raised, we like that's implied volatility going up. That's that balloon inflating. So your vega is the sensitivity of that options price to given changes, and managing your vega exposure is absolutely an interesting thing to think about in options trading. And actually, Ian, I might grab the screen back from you because I want to transition from thinking about one specific spread here to thinking about how spreads behave over time. And as we look at some of these prices, vega is actually going to be an interesting thing to look at and think about. So I'm gonna grab it back. So we talked about spreads and naked options. So thinking about spreads over time and how to trade options strategies over time, one of the ones that we have here at Harvested is called downside capture. And downside capture does what Ian talked about in a lot of ways, that it captures some of that downside. So by way of this simple put spread example, we sort of start to get the idea of what downside capture is actually doing. It's selling that downside volatility to capture some of that additional premium, but there's distinctly a directional emphasis to this, right? Volatility, while it might be an abstract concept in that, the volatility is 62%, this trade wins when the stock market goes up. That it's distinctly got a directional bullish bias here, but you are capturing that. You're defining that risk. So limited risk is important with, a strategy and managing that over time. I thought that was a great question, and that's why I wanted to get into risk budget, because the expected value of these spreads over time and the combinations of spreads over time allows us to compare that expected value with the risk management and risk budget and how much you want to allocate to that strategy over time. And using spreads is a particularly capital efficient way to do that. It's a particularly capital efficient way to provide that little bit of different into your portfolio. So downside capture sort of fits in our sleeve of strategies that we call amplify. And so amplify is one of those major themes of what option strategies can do to help manage and curate a portfolio. So in addition to amplify, we also have strategies that protect, and we have strategies that help diversify. But something like downside capture with its capture of downside volatility through spreads is distinctly an amplifying effect on a portfolio. So let's look at the last couple months in SPY here. And so this is the broad market index, the S&P 500 ETF, very liquidly traded, great for retail liquidity in the options market, extremely tightly priced, and very efficient, deep liquid markets there. So observers of the market will recognize this, that over the end of the summer, we creeped up. We slowly ground up, and all the way at the beginning of September, we were hitting these highs close to 360 in SPY. Then there was a little bit of a lurch, and we've stabilized a little bit more recently. But this period where we slowly crept up and then had the lurch is what I'm going to examine a series of trades, and that will show sort of how prices evolve over time and how the strategy is going to behave and collect those returns over time. So kind of continuing with this simple put spread as a sort of analogy or example of how to capture downside, we're going to look at how a put spread behaves over this period. And what we're looking at on the horizontal axis are a series of different dates. So if you sold a 1 week put spread every week, what would it look like? Well, here are the two differences in prices. That's the difference between your short leg and your long leg. And tracked in this lovely golden yellow is the net price of the spread. So we can see over the course of August how the price of that insurance is going down, 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 down. Now, this spread is parameterized by delta. And so we talked about that a little bit earlier, that by using a facet of the options model to find the spread to trade, we target approximately the same probability of risk on a given basis with this. So we look for something that is approximately 20 delta, or one way to think about that might be a 20% chance of hitting that option at expiration. So during that period when the market was going up, the price of insurance went down. When things are doing well, people, generally reduce the, cost of insurance. So if you were trading a spread strategy over time, you would gradually be collecting less. 14 cents this week, I think 13 cents, 12 cents, all the way down to, 11 cents here on 8/28. Well, guess what happens when the price of insurance went up quite a bit the next week? That was when that happened. So that was going to be right around here is your September 4th picture, where all of a sudden there's a little bit of fear in the market now post Labor Day, and we saw the price of insurance go up quite a bit. What a steady parameterization does here is it allows you to capture a little bit more here and a little bit less here. So you're not targeting the same price necessarily, but the same relative exposure. So while you might have lost on this contract, and I think I'll actually show it here, what these, this simulation would look like, you would lose, you only collected 11 cents at that, lowest point right there. But with the defined risk, it meant that the fact that the market dropped, $8 there, you only had a defined risk of $1 instead of losing that full $8 on it. So when you're kind of collecting these little bit amounts of money that are meant to sort of be an amplification of yield of your overall bullish thesis, you want to be very defined, because you don't want that steamroller to hit you and lose that $8 when the market makes the move like that. And I think, if 2020 has been any evidence so far, I think lurches in the market are frequent and expected to continue to happen. So defined risk really gives you that safety to sleep at night and manage your sort of expected outcomes with a limited downside. So I wanted to open it up to any questions at this point. I think we sort of talked about the evolution of how a spread is a defined risk and how that compares to a naked option, and the differences between, capturing yield and harvesting volatility from naked options versus defined risk, and how those sort of benefit in strategy execution over time. And a little bit how sort of the price of volatility will impact that over time, and how, by executing systematically and serially, we're able to capture those different levels of premium while maintaining defined risk exposure. So any other questions out there from our audience? Oh. Is there something like a set it and forget it model strategy available at Harvested? Yeah, that's a great question. And so what we just walked through right here was one example of one strategy, and sort of the distinct events, those distinct trades that compose that strategy. We also think about things at a higher level than that, an order of abstraction above strategies, in the idea of model portfolios. So for clients, investors that are looking to add a little bit of different through a distinct allocation to a combination of option strategies that follow along those themes of diversify, amplify, and protect that we talked about, we offer model portfolios that will execute a suite of strategies that are complementary and highlight those various themes. So one of our goals at Harvested is to make sure that clients are able to customize strategies to the degree that is interesting to them. I find options very interesting, as does Ian, but not everyone wants to dig into the level of Greek obsession that we might be. So we want to offer those sort of different levels so that you can set it and forget it, and you can get that exposure to the type of theme that is interesting for your portfolio without getting into thinking about the delta and rolling the trade. And that's our job as the options advisor. So great question there. Thank you. All right. Well, I'd just like to thank again everyone for joining us.
We have a couple more questions, Mark.
Oh, sorry, I'm not looking at the.
You know, I came up through the chat.
Do you want to go ahead and take them? Sorry, I missed
Let's
that.
see. We have for a naked call or put that's out of the money a day or two before expiration. When and if ever do you decide to roll the option versus cut the loss? Okay, excellent question. So for a naked option that's out of the money is a really good question. So you have a couple factors going on when you're naked short a call or put. We're discussing puts, so we'll stick with puts, but really, works the same, the opposite way, the converse. All right. So with expiration and being short options, you have things in your favor, right? There's something called theta option decay, and it really works to your advantage from the short side as you go 3 days to 3 days to expiration, 2 days to expiration, 1 day to expiration day. However, while that is great and that's part of the naked selling strategy, you also, as we saw with those graphs, as you get to the expiration style graph, it's kind of like very stark. Like once that out of the money option goes in the money, you start losing, $100 for every dollar move, times how many contracts you have. So rolling is probably a good idea, anywhere from, I would say, again, 1 to 4 days of expiration week. Again, part of it is kind of your portfolio. What else is going on in your portfolio? What is your risk tolerance? What are your anxiety? What type of risk are you looking at, and could you accept? So I would say, again, you would probably look 1 to 4 days and then looking to roll, because when you roll, you're generally rolling into something that's more expensive in an outer month, let's say 4 weeks away. Although you can roll week to week, but let's just say you're rolling 4 weeks away. So now we were short the 320 put in Spider. Spider's getting close to 320. I'm going to buy the 320 put and now sell the Dece 18th expiring 310 put. Like $3 or $4 or, whatever the price is. All right.
Yeah.
Does it make sense to sell out of the money calls and put spreads since the market can and both up and down? Excellent question. Now we're getting into some more really interesting strategies that, again, you can parameterize. So you're selling out of the money call spreads, you're selling out of the money put spreads. It comes down in a lot of ways to price, because you're right, the market can only go up or down. Now, the market can actually move both ways, so you might see some interesting optionality affect your P&L, your profitability in between. But you're right, as you get to expiration, it really comes down to the pricing. We'd have to look at, that's a great example for maybe a separate, maybe a lunchtime webinar, to look at selling out of the money put spreads and out of the money call spreads and seeing how the pricing works out. Because there may be at times where it really lines up very nicely for you, so you end up with minimal risk. There may be other times that you actually still have your small reward for what you're risking. So I know it's a little bit of a general answer, but something we have to look at the option prices specifically.
Well, an interesting example might be something. So we've been looking a lot at election scenarios at Harvested, and we do have our election product that allows people to express opinions and exposure and help kind of tailor that around the upcoming next week election. So when looking at the prices of expected movement around the election, this is sort of flipping the question on the head, but the general consensus is that the market is likely to move quite a bit around the election. And so the price of volatility is generally going to be very high. That to bet that the market would move more than 3.5%, you're almost paying 7 cents on an eight, or I should say it in like 82 cents on the dollar, 7/8 probability. So you have to put up a lot of money up front to bet that the market's going to move more than 3%, which is a big move. So by thinking about it in the opposite way, that when there's general consensus of one thing or another, it becomes a very expensive proposition to either expose yourself to the market not moving or bet that the market absolutely will move. So options traders like to stamp out those free lunches. So to the extent that there would ever be any arbitrageable, market doesn't go up or down, that's going to be reflected in transaction costs and spread widths and all of that too.
Definitely a good question to look at eventual back testing. And, are you just buying the proverbial put for a nickel for 20 years and just losing a nickel all the time? So, it comes down to pricing. And then was the last question for the self-directed option trader. How could Harvested Financial help generate new trade ideas?
Well, that's a great plug for our Daily Bread newsletter. So you can sign up on our website for the Daily Bread, where we walk through scenarios like this and talk about ways to take advantage of different opportunities in the marketplace and how one would use option strategies to take advantage of news events and interesting announcements on both stocks, individual stocks, and the broad market. So definitely check out our Daily Bread, both on the website and on our YouTube channel. You can find it. So every day, Monday to Thursday, opportunities in the marketplace.
Oh, you know what? I think we might have one last question. I apologize. Let's see. Renika call. I have one last question. How do I decide how to get long? Seems like buying call spreads and selling put spreads are bullish. How can I decide what's right for me? This is great. And again, it's going to be the topic of another webinar. You have a bullish thesis. You're bullish. So are you slightly bullish? Are you super bullish? Where are the option prices, the volatilities in the marketplace? If they're very high or very low, it may, it could persuade, systematically what strategy you take, either downside capture or what could be called a bull spread or a rolling bull spread, where like Mark had the example where you're constantly rolling downside capture. You do the same thing with the rolling bull spread, low volatility. I'm bullish. I'm going to keep buying little calls, call spreads every 4 weeks. So very good question. And we may have one more question here. Let's see.
I'll take the election scenario product question. So is there somewhere I can find out more information on this next week? So yes, it is next week. That product will be going away once November 3rd happens. So take a look now. It is at harvestedfinancial.com/election. So go ahead and take a look at that. And if you use our promo code /POMP, you will get $5 a month fee for your first 3 months. So that is our beta group rate. And anyone that uses that promo code will be eligible for their first 3 months at our beta rate. So definitely check both that product out, as well as our suite of other offerings, model portfolios, and individual strategies.
We have some more questions. Love it. Love everyone's interest in options. Okay, so we'll go. I saw Ken first. How can options pricing give an indication of what others think? Another excellent question. That's why the option market has so much great information in it. So sometimes a lot of people may say, well, let's look at the options market. What are we expecting from the election or from a specific earnings event, or even just from a macro perspective. So you can look at what we call straddles. And again, this kind of starts getting into kind of more kind of specific discussions, but just, briefly we'll at least, discuss kind of what a straddle is, which is just the at the money call and put. And those two options give you a price relative to where the underlying is trading. And just looking at those values, how expensive or cheap are they, give you an idea of what the marketplace, the giant marketplace, thinks of, an event, upcoming event, or a macroeconomic, I guess, situations, whether it's now or in the future. Because again, options are great because, especially when you look at something like the spiders or the Qs, which represents the NASDAQ 100, or the IWM, which represents the Russell 2000 small cap issues, right? There's different ways to look at these marketplaces and have options give you an idea. We're not going to look at skew curves today, but that's another piece of information, which just means skew curve just means, does every option that is listed on the spiders or Apple or Qs, do they all have the same volatility? The same implied volatility, I should say. And the answer is no. So those differences in prices, option by option, give you a real good idea what the marketplace thinks of risk in general. So really another great question, and another great webinar idea. So hope to keep presenting and discussing, and we might even have, let's see.
Yeah, I was going to say that actually bleeds well into the question about how much volatility is considered low. And it's a really interesting question. And I don't know that there necessarily is an absolute answer. But maybe to put some kind of order on that, one of the indicators that the market uses overall to determine the level of volatility is what's called the fear gauge, or the VIX index. And so the VIX index is a calculation of the implied volatilities on the SPX index, similar to what Ian was talking about. It looks a lot of different options and calculates a single number to determine, how much fear is in the marketplace right now. What is the level of implied volatility? With the VIX trading around 24-ish, that's a little bit higher than normal. A VIX of 80 would be something like the Great Financial Crisis, or that would be March of this year. That like the VIX going up to high double digits is indicative of crazy panic. It never ends up much lower than, call it 7, 8, or 9. That like there is somewhat of a lower bound on that as a function of just stocks move around even a very little bit over time. But volatility is really interesting because it's not necessarily like a stock price that goes up or down based on fundamental factors. That there are a lot of supply and demand effects to the pricing of volatility, and that there are a lot of recursive effects in the markets where participants are trading volatility that are also impacting the price of volatility. So there can be very long stretches where volatility remains extremely low, and then there are times where it persists and is higher than normal. So low and high is very relative in the volatility space, and I think that's why it's important to when trading volatility to manage that cost in a lot of different ways. You can think about it by trading longer term, more stable volatility. You can think about it in terms of trading in and out more frequently into volatility positions. So the high and low on volatility is perennially an interesting question.
And I'm just gonna, I love this question, and I'm gonna go to an anecdote. I love anecdotes. So when I was a trainee, when I was learning to trade on the floor of the American Stock Exchange, when we had paper and you had to write down in fractions, right? Who misses fractions? I miss fractions, right? Pennies. I miss fractions. But I started, and there was a trader. And this is a good distinction between volatility of ETFs and indices and single name stocks, that there was a trader who looked at all kinds of different volatility charts, very smart, and volatility in US robotics just kept going lower and lower and lower. So no matter however you looked at it, 90 days, 100 days, 400 days, 8,000 days, it looked super low. And he just kept buying options. So he was basically naked long, lots of options. And sure enough, over the course of 4 to 6 weeks, he just lost a lot of money. It did not move. So can be tricky. And again, that's a single name stock. So ETFs and indices have some different volatility to it. So that's why it's good to do research and understand the defined risks, being naked long, right? He didn't think it could ever go down, and it did. But if he had spreads on to reduce and have more defined risk, he would have had an opportunity when US robotics volatility most likely went up after he lost his money, unfortunately, as happens sometimes. So, that's why I think defined risk is really, really important when you're looking at stuff, and not just I'm naked long, I'm naked short. It really helps you stay in the game and, maximize profits and minimize losses. So it's my anecdote.
I think that's a good adage to leave it with, that the market can stay irrational longer than you can stay solvent.
Yeah.
So the importance of good risk management there.
Yeah.
So thank you everyone for attending again. Thank you for sharing a part of your Tuesday evenings with us. We will be hosting more of these in the future. And in the meantime, check us out on our YouTube channel, on our Twitter, harvested_DAFE. That stands for derivatives are for everyone. And we will see everyone very shortly. So thank you again.
Thanks, everyone. Have a great night and a great rest of the week.